Okay, so, and just in case you weren't sure the schedule, I think we do have a little hour and a half break, right? Isn't that right? We have, yeah, after this, we don't meet again till 2:30, and we are going to meet in the other room. Okay, so what we want to talk about after the break here is a complex trust. And so what we've got is a charitable bequest, and we've got a couple of beneficiaries. We're also going to see how we want to handle it when some capital gains get distributed to the beneficiaries in this case. And some of the things we've already looked at, we're going to kind of scoot along so we could talk about some other compliance matters and some elections towards the end, because we're trying to wrap up here by 1 today. So here, again, this is in your handout, and here's all the components of our complex trust practice exercise. And one of the things I want to point out to you is look about halfway down the page where we have our K1 of our royalty income is $4,800, but they only distributed $4,000 for this tax year. So that's going to affect how we do our accounting. And then we also have our depreciation here, which again, we're not showing in our income column, as we are showing our rental expenses right above that. And then in this case, if you look at the capital gain from the sale of stock, we eliminate it from our corpus, our principal column, and we're going to go ahead and allocate that capital gain to the beneficiaries, which should help to save them a little bit of tax this year. So anyway, so this is our worksheet with all the income and expenses that the fiduciary or the trustee has provided to us to do the 1041. And you know this, I forgot to mention something that came up on the break. So when we were talking about allocating the interest or dividends between the 1040 and the 1041 in the year of death, there was some concern that won't they get a matching letter for the deceased? Is there's a substantial amount of interest or dividends reported under their Social Security number before the accounts get closed or the funds get moved. So if you're not familiar with this in your software, virtually all of our software will have an entry where we can declare what's called nominee interest or nominee dividends. So, and generally you should have a place in your tax software where, and let's say in this example, there's $12,000 of interest reported for the deceased, but $8,000 went to the trust and only $4,000 is taxable to the deceased. So we should be able to go and now in the 1040, not the 1041, but we should be able to go into the 1040 in the Schedule B for the deceased and put a nominee adjustment, generally it's code N for nominee, $8,000, and your software may or may not have you report, for example, the name and EIN of the trust. And then you should see that actually print on the Schedule B for the deceased 1040 of the Schedule B that reports the entire 12,000 but backs out, in this example, 8,000. So for the fact that you're reporting 8,000 on the 1041 that didn't get reported anywhere, that doesn't cause any problems, right? That didn't get reported in the EIN, because you can always report more income than the IRS is aware of. But we do want to be careful if we're reporting less income than the IRS is aware of and take advantage of the nominee adjustment we're allowed to make on the 1040 Schedule B in this example. So I just wanted to bring that up, that came up on the break. Now, okay. So again, we've seen some of these little worksheets before, and I don't want to do a deep dive on these so we have time to cover everything. But here, again, in this specific software, we're laying out all the interest income and the dividends. We've got some tax-exempt interest again, and we've got our rents collected, which is, we've got our rents collected here, and then we've also got capital gains income, because we are allocating this to the beneficiaries in our complex trust example. Now, we're not allocating it just because it's a complex trust. It's just an example of in this trust example, we're allocating capital gains to the beneficiaries. Okay, and then, so that was our income on the previous slide. On this slide, we have our amounts to be allocated between exempt and taxable income. So in this case will be our fiduciary fees, and a certain percentage of those fiduciary fees and the tax preparation fees are deemed to have been paid with the tax-free income. So that will limit the amount that can be deductible on the front of the 1041. And then here's our 1041 specifically for, our complex trust example, where you're seeing the interest income, the dividends, the capital gains, and the rent income less expenses. And then again, we're going down to see our fiduciary fees. And in this example, we also have a charitable deduction, which we'll look at on page 2. And remember, part of the charitable deduction is deemed to have been paid by part of the tax-free income. Okay, and so here's our charitable deduction of $5,000, but $76 of it is deemed to have been paid with the $900 of tax-free interest. So the deductible charitable deduction is $49.24. And again, we should be able to trace those numbers right off our little worksheets. And then here is our page 2 of our 1041, and we're going to look at the accounting income and the distributable net income in a minute also. So here we've got our total adjusted total income, which we'll look at on our little worksheet. Here's our adjusted tax-exempt interest. Here's the capital gains. And in this case, the capital gains are backed out, but you're going to see how we're going to adjust that, because we do want, in this case, the capital gains to be attributable to the beneficiaries, taxable to the beneficiaries. And because this is a complex trust, you're going to notice that your line 8 and your line 10 are calculated, okay, on our Schedule B, because it's a complex trust. Okay, so this is where we have some work to do as the tax practitioner. So remember how in our simple trust, it already knew about the extra $5,000 we paid for property tax, but I had to go in and allocate, for example, the tax prep fees. But we've got a lot going on in this example, and we're going to tie the accounting income to the distributable net income in a minute. But this is literally the worksheet in the 1041 software on Schedule B. And I'm trying to put in all the components of income and expenses that I need to worry about that haven't been put as a deductible item or an income item on the trust. So first I've got to allocate my tax prep fees between income of the trust and the corpus of the trust. And remember, we had a question before the break, how do we know it's 50-50? Because it's always 50-50. That's how we know. There's no special allocation or percentage. Question? It absolutely is. So good question. Yeah. So it's also subject to whatever a state is driving compliance for the specific trust. If that's the state law has a specific criteria to use to allocate those fees, you would definitely pay attention to that. And then we're also going to split half of our fiduciary fees, our trustee fees. Now, so because we've taken these tax deductions on the front of the 1041, $1,500 for the tax prep fees, and I believe $3,800 for the fiduciary fees, we're actually adding those back to come up with our trust accounting income. But I haven't entered the $2,000 of brokerage fees anywhere because it's not deductible on the 1041. So that's why the brokerage fees, half of them are getting subtracted here instead of added. Now, the non-deductible pre-rental condo HOA fees, we've determined, remember in our previous example, that we're going to attribute the condominium fees, the HOA fees, to corpus because that's an asset of corpus, the condominium is. So I'm listing that here just so you don't think we forgot it, but we're actually not going to make an adjustment for the condo fees, even though those fees were paid. They're not tax deductible and they will not adjust accounting income. Then we've got an accounting K1, we have an investment K1 with $4,800 of taxable income, which is showing on our 1041, but they only distributed $4,000 this year. So I have to subtract $800 from my accounting income because we did not receive that cash this year. And then I've already allocated my $19,000 of capital gains to the beneficiaries. So I'm going to go ahead and put a 0 here, but I wanted you to see that that we're accounting for the capital gains in this case because we're going to have the capital gains taxed to the beneficiaries. So here's our little worksheet, and then we've got our little Excel sheet here. Now remember, line 1 is where we saw that on the top of our page 2, Schedule B, for our complex trust 1041. And it's also on line 17 of page 1. Then we're adding our tax-free income less the expenses allocated to the tax-free income. Then we're adding our Schedule D, line 19, for the beneficiaries' capital gains. And then we don't have any capital gains allocated to charity. And then we don't have any capital gains on the Schedule A, line 1, which is charity. Now, then we are subtracting the capital gains, which are already reported on line 4 of the 1041, okay? So there we've got our distributable net income, $40,053. So what's happening when we did our simple trust is we went ahead and backed those capital gains out. But that's why we've got them on line 3, because we don't want to take capital gains out of our distributable net income for this example, because that we want the capital gains taxed to the beneficiaries. So that's why we added it back on line 3. So that's our distributable net income for these K1s that we're preparing. Now, an adjustment for accounting income is we're going to add back the charitable donation, okay? So now we have our tentative trust accounting income because our charitable deduction was paid out of trust accounting income. Now we have to do our allocation with our half the fiduciary fees, our half the tax preparation fees, and we're subtracting our $800 of our pass-through K1 royalty income because we didn't receive a distribution totaling the entire $4,800 this year. And we're subtracting half of the non-deductible brokerage fees. So that is getting us down to our final accounting income. And remember, we said, because this is a complex trust, line 8 on the Schedule B, and remember, Schedule B is page 2 of the 1041, line 8 is going to calculate, and that's our $45,953. That's where we got that number. And a lot of times this is done behind the scenes by our software, and we're not really sure what the heck they're doing. So this proves our numbers on our 1041 sample. Okay, and then again, we've got some of the compliance items here on page 3. I'm going to go ahead and scoot along, but remember, the number that we'll have on many of our trusts that have the tax-free income is you'll see that on line 1 of the other information section. And again, most of our software will input that for us based on our income worksheet. And then here we've got our Schedule D, which is showing our capital gains, our $19,000. In this case, we're allocating that entirely to the beneficiaries. And then I have no idea why my 89 is blank. I think it's because I probably entered directly on my Schedule D, let's say. Okay, now here's our Schedule E. So what we've got in our Schedule E is we have our rental income, less expenses, but we've also got our K1 for $4,800, and that is our royalty income. And then don't forget, we had to make an adjustment because the distributions that year from that K1 wasn't $4,800, it was only $4,000. Okay, and then here's where this is a PTP, investment trust PTP. It's showing on our Schedule E page 2, but it's reporting on page 1 because it's a royalty, so don't get confused. And then here is our QBI allocation for the trust. In this case, all of the rental income is going to be flowed to the beneficiary and none to the trust. So that's why in this example, we see we have nothing in the trust estate line. And because the rental that's passing through with the depreciation is going to have a loss, there's no QBI there. Although we do have a little QBI statement, excuse me. So we have a negative, the rental income, the $34,18, and then we also have the royalties in this case are flowing. And it says rental income, but that's just a limitation of the little worksheet. It's really the royalty income that flowed over. Okay, and now in this example, our complex trust, we've got two nephews. We've got favorite nephew that gets 50%, and he also gets $1,000 a month of funds, whether or not the income is high enough to provide that. And then the Nevada nephew, the less favorite nephew, he only gets his 40% of the income, and he doesn't get any little monthly stipend, okay? So those are the two of the three K1s, and our third K1 is the charity that gets basically 10% of the income in this case. Now, I will tell you that you're going to see charities handled different ways. Remember, it might be a lump sum, it might be a percentage of assets. I've actually done trust before where they've just literally given the money to the charity, and we've said, instead of 40% and 50% for the nephew and 10 for the charity, we just went ahead and said, what would the allocations be if we only gave the nephews K1? It would be something like 55-45. They gave the charity the money, and we never issued a K1 for the charity. So don't worry too much. And I'll tell you something else. A lot of times we may be called upon to help, like the attorney or the trustee or someone, allocate assets in the final year. Keep charities always in mind. I had a fellow a couple of years ago passed away with an enormous, like more than $30 million of real estate trapped in S-corps, believe it or not. And S-corps do not get a step up on date of death. Only the stock does. It's a fiasco when you've got real estate in a corp. And guess what we did? He wanted it, I think it was about 12 million was his exclusion that year. 6 million went to the girlfriend, 6 million went to his sister, and all the rest of the money went to these two charities. We gave the charities all the real estate that wasn't going to get a step up. And so you may be called upon to help a trustee or someone allocate assets. Keep step up in mind. Keep a charity in mind. You can push taxable income to a charity. They don't care. They're not paying tax. So a lot of times you may be called upon to help someone make a decision or to allocate something. And so keep the tax benefits of the assets that may be split up in mind. I've also had a client, I think I mentioned this in our webinar, that because the taxpayer and spouse, there was a second marriage and they had different heirs, they literally said everything gets put in the B trust was to protect, in this case, the wife's heirs because she died first. Everything that was left in the survivor's trust were for his heirs. But their living trust that they had together while they were both still living literally said, when the second spouse dies, allocate the assets equally among our heirs and share the tax attributes of the step up equally. In other words, don't just stick the first spouse to die's heirs with all the property that didn't get a step up in the last 15 years. They wanted the tax practitioner to work with the fiduciary and say, well, yes, they're all getting, $2 million of assets, but these people are getting a step up based on this year's value, and these heirs are getting a step up that's 12 years old, for example. They had us actually allocate what was a fair allocation of the assets, so everybody benefited from the new step up and everybody had the burden of an older step up. So keep in mind, you're going to see trusts that ask you to wade in and help someone make some of these allocations or help them make some of these decisions about where assets are going to go. Okay, and so in this case, and I've got a lot of verbiage here, okay, the favorite nephew, as I mentioned, gets 50%. And then we've got the math of how this all works out, and he gets the one that gets the extra $1,000 a month. And remember, this is a complex trust. It's a complex trust for a couple of reasons. One is he got a flat dollar amount, whether or not the income was high enough. And the other reason, we had a charitable contribution. So this became a complex trust. And by the way, that extra $1,000 a month to the favorite nephew, that's tax-free to him. He's still only going to pay tax on his, in this case, 50% of the income for the year, even though he got an extra $1,000 cash per month. So then here is the favorite nephew K1, which is 50% of the taxable items that are permitted to flow through, including his share of the $19,000 capital gains that we allocated to the beneficiaries, and his share of, for example, the depreciation. And then here is the Nevada nephew, the 40% beneficiary, and his pro rata share of the items on his K1. And again, there's a lot of math here, but we should be able to go back through our little worksheets and prove out these numbers and how these numbers were allocated to these different beneficiaries. And again, here's the 10% that went to the charitable organization. And again, charities don't pay tax, so this is not something that's going to burden the charity at all, and they very likely got more cash than they're being allocated. So again, what we also have is a little worksheet in your handout that shows all the amounts that are being allocated to the 3 beneficiaries, and so our 3 K1s should total these dollar amounts that we expect. This is very, like, if you think about Schedule K on a partnership or Schedule K of an S corporation, that's basically the total activity of the entity for the year, and then everybody's K1 is their pro rata share of that activity. That's how this little worksheet should be the total reportable activity for the year, and then each K1 would show the attributable percentage. And then we have a little worksheet also which does the computer calculation of the distributable income, and this should line up with our little Excel worksheet where we compared the trust accounting income with the distributable net income. And then again, this shows the allocation of the income and the dividends and everything based on category of income by column. And it just is to help you walk back some of those numbers if you want to review this after our presentation. It gets a little confusing. Okay, so for the last part of our presentation, what we want to talk about are some compliance matters with basically reporting the Form 1041, the estates and trusts. So generally, all trusts which have currently distributed income to beneficiaries are obligated to furnish each beneficiary a K1. You are going to encounter a lot of cases where somebody can't find someone. And I've had this happen before where there's, let's say, 5 grown children and 4 of the siblings have not talked to one of the brothers in 25 years. They have no idea where the fella is. Sometimes they don't even know if they're alive, okay? And so, again, number one, most of us are not attorneys. I'm certainly not. And number 2, depending on how fee sensitive someone is, depending on how hostile a situation gets, you may not want to get that involved in this. You may advise the trustee or the fiduciary that you need to get me the names and addresses of the people that are, the beneficiaries of the trust. And let's say that there is someone that you absolutely cannot find. And let's say they're supposed to get 25%. Basically, you're probably filing on paper, okay? You're going to tell the trustee, I'm going to do the name and the last known address, the Social Security. I mean, you'd be surprised how many grown children do not know their siblings' Social Security numbers, right? And a lot of us do because we do our family members' tax returns, right? But what happens is that you may be filing on paper because that person is entitled to that income distribution and is entitled to, and so you don't have a Social Security number. And you certainly are not going to say, well, we're going to divide it by 3 because we can't find the 4th person. I would absolutely positively not get involved in that at all. And if the trust actually designated income to go to a 4th person, I wouldn't even let the fiduciary to tell me to file it that way, or they probably need a new tax preparer. So sometimes I've had to say, we're going to have to mail this until somebody can find this guy. And so on a case-by-case basis, you're going to figure out, and then we want to a little bit kind of say, you're going to have to kind of hold back these funds because they technically belong to this person. And so sometimes, and I had this conversation earlier too, if you're trying to wrap up a trust or help someone that is, let's say there's not really a lot of assets and nobody's getting along and they just kind of want to get it over with, you might suggest that if they're actually holding funds where they can't find someone, put it in a checkings account, not an income-bearing account. And just tell the fiduciary or whoever is in charge of maintaining the funds, maybe don't have it generate any income, especially if it's not a ton of money where you're not giving up a substantial amount of income. Park it in a checking account where it's not going to throw off any more income. Everybody got their money. That missing person's money is parked in a bank account until they decide what to do. Are they going to wait 7 years and have them declared dead or something? I don't know. Yes, sir.
Is there a lapse of time, and I know this varies from state to state, where you have to turn that money over to the...
Excellent point. Yeah. So the point is, based on the state law, is this something that we have to turn over to the state as unclaimed property? Very likely. We should all probably be familiar with that rule in our specific states. I don't even know what it is in California, frankly. But that's an excellent point. And again, that wouldn't be our responsibility, but that's something we may want to pass along to the fiduciaries, right? Especially if they're thinking about, well, we'll just split it 3 ways because nobody can find Bob, you know. You might tell them that they've got an obligation, right? Depending. So anyway, just we want to protect ourselves a little bit, and we also want to potentially help our client that's hired us to do the trust tax return to help them stay out of trouble, right? Now, I often get new practitioners call me up and go, my client got $100,000. How come her K1 is $1,700? And this is just really bothers new practitioners. So again, remember, the trust is reporting taxable income, the taxable income that is reportable for that specific beneficiary. It may have absolutely zero relation to the funds they actually received. So just keep those things in mind. And a common thing to think about too, and I often explain this to brand new practitioners, and I'm going to do the math wrong, but let's say that the income is $5,000 and the expenses, tax deductible expenses, are $2,500, then we expect the K1 to really just show the taxable part after tax deductible expenses on those K1s, because that confuses a lot of people too. Gee, the 1099 int said $5,000. There's only one beneficiary. How come their interest on their K1 is only $2,500? Well, in this example, the tax deductible expenses happen to be $2,500, so they're only getting taxed on the taxable portion of the interest, regardless of how much cash they got. So we just have to keep in mind the 1099 ints, the 1099 divs, K1s, whatever. Those are the income documents, and then we're looking for deductible expenses that we may get a record from the trustee or the fiduciary. And this could be very informal. If these people are not having any kind of infighting, if they haven't been mandated by a court that they've got to file reports or something, and there's even, we saw in our trust documents webinar, oftentimes they say the requirements to report the income and expenses to the beneficiary can be met by the annual tax return. So sometimes you're getting very informal records from the trustee going, oh, by the way, I paid this property tax bill. See, it's got the check number here, you know, and by the way, I paid this fee, and you're kind of wrangling this all together and putting them on your little worksheet or your spreadsheet going, okay, I have the activity I need to report this year, but it may be kind of informal, and we just have to do the best we can to gather the income documents that were reported and then the expenses that were incurred and paid. Okay, so, all right, now, because qualified dividends get taxed at the capital gains rates, okay, so, okay, let me see if I can say this right. Because qualified dividends get taxed at capital gains rate, trust expenses are generally allocated to the portion of dividends that are not qualified dividends, if you're following me there. So again, we should see our software kind of do that in the background, but don't get confused. Why aren't they reducing qualified dividends by the amount of these expenses? And that may be by design in our software to try to save a little bit of tax. And then the trust expenses, trustee fees, tax prep fees, and legal fees allowed in full against trust income, those are allowed in full, but they may be allocated, as we've seen in our examples, between tax-free income and, between tax-exempt income and maybe even capital gains, depending on how the trust document says to handle these things, okay? And then these common expenses that we're talking about that are generally expenses incurred solely because a trust or estate exists. And remember, what's our biggest exception to that exception is the tax prep fees for the deceased, okay? Are fully deductible, tax deductible by the trust, even though they wouldn't be on the deceased's 1040, okay? And so these are deemed not to be subject to the 2% floor because they're considered to have been incurred solely because there was the existence of a trust. Now, in the final year of a trust, we may actually only have expenses and no income. So let's say that, and again, if you're trying to help someone kind of wrap up or tidy up, and for example, somebody may say, well, I'm going to hold back $10,000 or I'm going to hold back $20,000 just to pay any remaining fees or anything that might pop up. You might say, put it in a checking account. Don't put it in a savings account, because then next year you're going to pay, for example, my fee, any other fees that might pop up, and then you're going to just distribute that cash to the beneficiaries, but you may not have any reportable income for the beneficiaries. Maybe the only thing that you're going to pass out to the beneficiaries in the final year is going to be their pro rata share of, for example, the trustee fees or the tax preparation fees. And we've got so it's not uncommon for the final year of a trust to have no taxable income at all on the K1, but to have deductible expenses pass out to the beneficiaries. And we've got some notes in your handout here on what those codes are and our guidance for those codes. So for example, we've got an IRS notice TD 9918 that specifically discusses these expenses. And this notice was put out around the time of Tax Cuts and Jobs Act to kind of clarify these issues when the miscellaneous itemized deductions subject to the 2% floor were drastically curtailed, let's say. So if we have a 1041K1 Box 11 Code A, those are what they call Section 67E expenses. So these are excess deductions not classified as miscellaneous deductions subject to 2% floor, and they're reported on the beneficiary's 1040 Schedule 1 Part 2 line 24K. So generally speaking, these would be attorney fees, probate fees, trustee fees. If they would have been deductible on the 1041, but the only thing passing out now in the final year of the trust are going to the beneficiaries, anything Box 11 Code A on the K1 for the beneficiary, that is deductible on Schedule 1 on their 1040, okay? And so then, and if the beneficiary doesn't have enough income to absorb them, there is no carryover. And again, we reference the notice TD 9918. They actually have several examples in there of allowable excess deductions and the treatment of those deductions on the termination of a trust. Now, another code we may see is Box 11 Code B. These would be excess deductions on termination that are considered non-miscellaneous itemized deductions. This would generally be acquisition debt mortgage interest, or it would be property tax, deductible property tax, not related to a rental or anything like that. And so these would be deductible on the beneficiary's Schedule A up to the specific assault limitation or acquisition debt mortgage interest, that type of thing. So that again would be on a Schedule K1 from a trust, Box 11 Code B. And then the next two codes that may pass through would be the unused capital loss carryover. In the final year of a trust, those capital loss carryovers are flow out to the beneficiaries by their pro rata share. And we're going to have Code C, I believe, for the short term, and then Code D for the long term. And again, those are reportable on the beneficiary's 1040 from the final K1. And then the final one would be if there's an NOL. So if there's a rental property or Schedule C or farm or something else that was on the trust in the final year of the trust, if the trust had a net operating loss carryover, that could potentially flow out to the beneficiaries on their own returns, okay? And then that would be, wait a minute, yeah, that's box 11, code E or F, depending on the type of carryover. Oh, and by the way, if it's code E, excuse me, that's actually eligible to go on Schedule 1, line 8A. So anyway, so this is how in the final year of the trust, we would expect, and by the way, part of this our software is going to drive, right? Because our software, we're gonna check in our software, this is the final K1. This is the final year of the trust. And by the way, if you ever do a final trust and then they show up next year with a 1099 int for $40,000 of interest, it's the same thing with any other entity. Just file another return. You will not get a letter that says, why did you file a 2026 tax return? You specifically said 25 was final. If there's reportable income in that EIN, just do another trust return, mark that one final. They'll probably never, ever get a letter. But those things happen. Okay, now, and I think I mentioned this right before the break, that sometimes somebody will like get an EIN for the trust, and there's literally no income in the trust that's reportable for several years, and somebody is just living in, let's say, mom's house. So somebody might get an EIN, and you may not file a trust tax return until that house sells in, for example, 9 years. And the only thing that's going to be on that trust return that year, we're reporting the 1099-S for the sale of that house, and depending on the capital gain or loss on that house based on the value on date of death, potentially, and if the house has been a rental, obviously there would have been K1s on all the intervening years, potentially, or the trust would have had taxable rental income if the rental income didn't pass out. But sometimes you will go years and have nothing filed at all for a trust, and then boom, a piece of property sells. Now you're filing that year, okay? And what if there's two houses? What if the deceased, her sister moves into one house and her brother moves into the other house? You might sell one and 5 years later sell the other one. You don't know. So unless there's reportable income, don't worry about skipping filing for a trust. And I would do the same thing if you have a client calls you up and says, we got an EIN. You're like, okay. And then you get the paperwork for that tax year and you're like, well, there's absolutely nothing reportable here. And it's not going to be the final year of the trust because we're still sitting on this piece of real estate. And so we might just not file for a couple of years, and you just advise your client, we don't have to file this year, even though you got your EIN, and chances are they are never going to get a letter saying, why didn't you file? And the IRS has got so many phantom trust EINs, you have no idea. So unless there's actually income, like a 1099-S reported, generally no one will ever get a letter saying, why didn't you file this trust? And even in those cases, I still think matching letters for trusts are very few and far between. So we want to talk about maximizing income tax deductions for the trust. So as we mentioned, the Tax Cuts and Jobs Act suspended a lot of things we normally would deduct for carrying the assets of the trust. For example, all the fees related to repairing mom's condo and the HOA fees and the insurance, those things are no longer deductible. And so we already chatted about it generally would benefit the family to have the heirs pay those fees out of pocket and not pay them out of income of the trust, but we can't always control that. And so then we also have some final regs specifically related to the deductible expenses, and that would definitely be in that TD 9918. Costs incurred by the estate or grantor trust subject to the 2% floor if they would commonly be incurred by an individual holding the same property and incurring the same expense. So that's really how we evaluate whether some of the costs that the trustee paid for the year, whether we can actually deduct it on the 1041 or not. And so generally trust and estate expenses that were not normally subject to 2% floor, that would be the one. And then also, and therefore fully deductible on the fiduciary tax return would be the attorney fees, trustee fees, other fees specifically related to the trust or tax preparation. And remember I said that we may have to, for example, allocate brokerage fees or something like that if they were providing specific services that the trustee had requested rather than just managing the portfolio. And then the final regs in the TD 9918, they also address the ownership costs. For example, holding on to the house, tax return costs, investment advisory fees, bundled fees, and all those fun things. And so then, as we talked about property ownership costs, again, if they're generally incurred by an individual, they wouldn't be deductible, and there's our condo fees we've already been chatting about. And then costs incurred by the trust after 2018 to simply maintain property or maintain vehicles, if it's not a rental property, those would not be deductible. Any property tax that is not a rental or commercial property would definitely be subject to whatever the SALT limitation is for that year. And then ownership costs related to assets used to generate income, for example, rental property, those would all be deductible. I think I have a slide on this. I'm going to mention it now, and if we get to the slide, whoops, did I go too far? Yeah, here we go. I'm going to mention this for fun, especially when SALT was still $10,000. Let's say mom dies in May, and she paid half her property tax, and obviously this would be someone who's got kind of fairly high property tax, and then the second half of the property taxes got paid by the trust. So sometimes in the year of death, you could actually get $20,000 on mom's property taxes if they were still holding the house and it wasn't a rental. If by the time the second property tax bill comes around, it's already a rental, or it's become a rental, obviously you can deduct it as a rental. But there's definitely been cases when I've been able to get double the property tax in the year of death, depending on how the payments were made, whether it landed on the 1040 or the 1041. And then let's see what we have here. Yeah, property tax, real estate is deductible, subject to SALT. And then, okay, and then, okay, so now, and we've already talked about tax return preparation costs a great deal, so I'm going to scoot past that. And remember, the deceased may be a non-filer. Yes, sir?
The property taxes have to be paid by the trust?
They don't have to be. They certainly don't have to be. Generally, if the asset's held by the trust would pay it. And depending, but that's a great question. Do the property taxes have to be paid by the trust? Let's say you've got two 50-50 beneficiaries, they're siblings. And let's say, I mean, I had a client die recently and her property taxes are, you know, like $80,000 a year. When I first met her, I'm like, do you live in a castle? And she's like, no, but it's a very nice house. I'm like, I bet it is. That was a few years ago, because I don't have any clients whose property taxes are $80,000 a year. But anyway, my point is that might be something we might, again, if everybody's getting along and you can get in front of it, you might want to say, if you and your sister pay this property tax, we wouldn't have to, we wouldn't be trapping more income at the trust level at the higher rates, you see. But because, again, as long as let me state this too, because this comes up a lot. There are no trust police, okay? Your biggest exposure as a practitioner would be that you didn't report something correcly, like you reported a step up that isn't applicable. Like, let's say that you went ahead and there was an appraisal on all the Trust B assets, and you went ahead and reported that step up for some crazy reason on the Trust B assets that weren't supposed to get a step up on the second death, for example. Or you did some other allocation that is either against state law or is not in agreement with what the trust indicated you should do. Potentially in the event of an audit, they could then come back and say, well, you, the practitioner, reported these assets incorrectly. This trust now owes additional tax, and by the way, it's your fault because you did it wrong, and there may be penalties and interest and those types of things. And so that's one exposure, but the other exposure is just infighting among beneficiaries and heirs. And that's the one that I think we want to try to stay out of danger, because these people, they don't get along, you know. I mean, a lot of these people, you're going to find a lot of infighting and a lot of, they don't want, one of the worst things you're ever going to be involved in sometimes is going to be co-trustees. Because if those people are not getting along or they don't agree on how to handle something and they both have equal say, it can be painful. And sometimes you're going to have to just let those clients go. Because what don't we want? We don't want, there's like 5 siblings, none of them are getting along. They're all fighting over mom's estate, and now the lawsuits are starting. I don't want to go testify down at the court. And so you really want to pick and choose your clients, right? By the way, I hate to say this, but your client's gone now. So you need to decide, is that an estate that you want to mess with? Is that a trust return you want to mess with? Because if there's a lot of infighting and arguing and you're just going to get pulled into lawsuits, I've got one right now where the family was very wealthy in San Diego County, and the fella, based on his religion, was not allowed to have a lady caregiver, and he was ill for a couple of years. Well, mom is now in a relationship with the male caregiver and is getting ready to disinherit her 3 grown daughters, one of whom's an attorney. And I am getting screaming phone calls, and I'm like, you know what, I'm out. Not only did I not do the tax returns for any of the grown daughters, but as far as I'm concerned, mom can go to her new boyfriend's CPA, and I'll go work on other stuff. So you're going to get involved in stuff like this. It gets ugly, and the lawsuits start flying, and we might want to go, yeah, I'll pass. Yes, ma'am. Oh, so that's an excellent question. So the point is, if some of these costs of carrying the condo, right? So that's actually, ooh, help me out here, 212 maybe? I think that's a section 212 thing, and a 212 question. So let me answer it this way. And I don't know if you're familiar with Ed Zolar. I love Ed Zolar, and he had a point of view on this. The whole point was when we weren't allowed to deduct, when the SALT limitations came out with Tax Cuts and Jobs Act, the IRS came out with some guidance that said, if you normally capitalize, for example, property tax on raw land that you're holding for an investment, if you were over the SALT limitation that year and you wouldn't have been able to deduct it on A, you can no longer elect to capitalize it. So then the question becomes, and this is kind of a gray area, the question becomes, if we couldn't have deducted it on the trust tax return because it's an expense considered subject to the 2% floor, can we really capitalize it? Now, in my opinion, A, is our exposure too gigantic? Probably not. But I would research it a tiny bit and be sure you're comfortable with whichever way you land. Because there is a point of view that says if it wouldn't be deductible the trust, you may not be able to capitalize it. But if it would have been deductible the trust, then you're making an election to capitalize something that would be deductible. So I'll answer it that way. I know a lot of people that capitalize a lot of stuff that's no longer deductible because of the 2% floor disallowance. And I don't think there's a huge exposure for us, but I would be careful saying definitively capitalize every expense you can't possibly deduct, because there is some question there. So I'm going to scoot along here so Dan doesn't get mad at me. We've already done, okay, so investment advisory fees. We've also talked a great deal about that. Advisory fees for just managing the portfolio are not deductible for federal, but they may be at your state, right? And not just based on state law, it may also just be your state conformity to the federal tax bill. You may get a benefit from the state. And then we already talked about bundled fees. If we feel that some of our bundled brokerage fees included specific services that we asked the brokerage firm to help us do for allocating assets or something, some of those may be deductible. We've also mentioned the same thing with appraisal fees. So this was an IRS example. If the appraisal is to allocate assets among the beneficiaries or determine the date of death value, those fees are deductible. But if the appraisal fee is just, for example, to determine that we have the right amount of insurance on an asset we're going to hold on to, that's probably not deductible. And then we have the probate costs, bond fees for the fiduciary, all those types of things. Any cost that we're incurring specifically because of the trust or the estate is definitely going to be deductible. And then we've talked about the state and local taxes paid. I think this is where the top tax note is, where I mentioned sometimes you can get the whole amount in the same year of death. You can get half the property tax on the 1040 and half on the 1041. And here I have the note, and this will be in your handout, about can we capitalize the property tax. In theory, we can't. We've already talked about QBI. I think I just have a couple more. And then I have some costs for the sale of the deceased taxpayer's home. and then talking about how do we want to potentially capitalize some of those costs there. And then we also have some information here on amortized bond premiums, which I won't do a deep dive on, but if you're getting brokerage statements that show amortized bond premiums, you might refresh yourself with this part of your handout, because sometimes, because we have to allocate some tax deductible expenses to tax-free income, if we have a reported amortized bond premium, we may be able to lower the amount of tax deductible expenses we lose to tax-free income. And then, as promised, we've got some information at the end of our handout about specific elections. One is, and this where we may be called on to do, because for complex trusts, because they're so tied to did you distribute the money this year or not, they have a little 65-day window that they can make an election to say we get to count anything we issued or we distributed in the first 65 days of the next year as distributed this year to maximize the tax savings. So a lot of times you'll get that phone call in January going, we're uploading all of our brokerage statements now. Tell us how much we have to distribute. We only have 65 days. And so be aware that you might get that phone call in the middle of 1099 season, for example. Yes, sir.
Can you use the 65-day election on the final year? There's a lot of, some people say that election is not available on a final return. Do you know?
On a final, that's interesting. I don't know off the top of my head. I'll be happy to check, but I've never heard it isn't. But that's interesting. So the question was, if it's the final year of the return, so in theory, the trust isn't operating next year, what could you be distributing in those 65 days that you could make that election for? Interesting. Yeah, I'm not sure. And then we have, oh yeah, this is the 65-day election. And then we also have the 645 election, which allows a trust to be treated as an estate, and that is kind of related to whether or not you can select a fiscal year. Sometimes if they die later in the year, you can use a fiscal year, let's say October to September, and not have to straddle 2 tax years. And then we have another election. Yeah, this is the same election. And we did it. It's 103. We're a tiny bit over time.